Hayes Advantage with Kathleen Hayes and Vonnie Quinn.
David Edwards is back. He's president of Heron Financial Group here in New York and in studio. Thanks for joining us.
Good afternoon, Kathleen.
So, all the volatility, we had debt ceiling volatility, we had budget standoff, we've had so much volatility related to Washington, particularly in budget talks. Did anything the president say, any of the takeaway from his inaugural address, looking ahead, does it make much difference now to what happens this year compared to last?
I think in recent years, people have obsessed too much about macro events and Washington policy events and stopped actually looking at the underlying stock market. The S&P 500 is no longer an investment in the U.S. economy. It's an investment in the world economy. And we're looking at record revenues for the S&P, record earnings for the S&P, record cash on balance for the S&P, valuations a little bit higher than, let's say, a year ago. So it's not unreasonable to forecast an 8% growth in the S&P 500 no matter what happens in Washington.
Why is this, though, David? Why have we seen the big advance that we have for stocks?
The interesting thing is 25 years ago, 1987, the U.S. stock market fell 22% in a day. And most Americans found out about it the next day by reading it in the newspaper. And it wasn't until, let's say, 2002 on that we got to the point in our nation where everywhere you go, the shoe shine stand, the airport departure lounge, your sports club, your bar, you've got the Dow ticker in your face 24/7 telling you to go, 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 do. And so the things that happen on Wall Street on Washington on a day-by-day basis start having much greater impact on people's investment decisions than they really should. My firm is an old-fashioned firm. We hardly pay any attention to what happens on a day-by-day basis. I don't even know where the index is closed in the day. I don't care. I'm looking at by month, quarter by quarter, year by year. And what I see for the last several years has been cautiously optimistic. Last year, I put in a forecast of 12% for the S&P 500. It came in at 16%. I feel good about this year, but I also feel like some of 2013 return was dragged into 2012, so I've got a lower number now, 8%.
You say that stocks are going up, based on the global story, but, the fundamentals globally are not all that hot.
That is absolutely correct. We had a pretty ripping emerging market economy even through 2010. Chinese economy has eased back somewhat. The Middle East has eased back somewhat. But meanwhile, the United States, which has been stuck in a low gear for a couple of years, is just starting to roll again. So we look at unemployment situation right now, it's about 7.8%. We're thinking 7% by the end of 2013, 6% by the end of 2014. But probably the most interesting thing right now is that housing prices, which fell dramatically from 2006 until the spring of 2012, stabilized and started rising this year. And most Americans don't have their wealth in stocks or bonds. They have their wealth in their house. So if their house is falling in value, their consumer confidence is low, and it impacts their spending decisions. But now we see the opposite effect. Housing prices are stable to rising. People feel a little bit better, and it flows to the whole economy. So just as the emerging markets are giving up their energy, the U.S. market will start to pull the train again.
So isn't it understandable, though, that after many people just got pummeled when, stocks fell so sharply during the worst financial crisis since the Great Depression and our Great Recession, that they're saying, I don't quite believe it yet. I mean, don't you think it may be wrong, but maybe that's how the brain works. They're still scared something's going to happen.
Yes, we call this behavioral finance. People do what their gut tells them to do, not what their brain tells them to do. So I'm a high net worth advisor. And I've got a long list of prospective clients I've been talking to off and on for a couple of years now that have high six-figure incomes and mid seven-figure and high seven-figure portfolios that went to 100% cash in March 2009 and are still
100%.
afraid.
So they didn't even go into bonds?
Nope. They went 100% cash.
Or commodities?
I talked to one guy. He's the number 4 executive of a S&P 500 company. And I say, hey, how's your company doing? Oh, my God, awesome. We're expanding in Asia, Europe. It's just records all around. It's really, what's your money doing? Well, I have it in 20 banks. Why? Because if the banking system collapses, I want the FDIC insurance. And so I told him, well, if the system collapses, there won't be any FDIC insurance, number one. Number two, on the one hand, you're assuming the end of the Western civilization, but on the other hand, it's never been better for your company. So one of those two can't be correct. Which one is it?
What do you say?
I'll get back to you.
But that doesn't inspire confidence. I mean, if a top executive in one of the S&P 500 firms is not comfortable getting into the market, why should we be?
Well, because we all have to retire eventually. And if your investment strategy is based on CDs at 0.1%, you'll never be able to retire. And so the conversation I have with a lot of my prospective clients is, I get that you're afraid. I get that you're concerned. I get that you don't trust the banks anymore. You don't trust the government anymore. You don't trust people like me anymore because I think I might be Bernie Madoff in secret. But what if we start scaling you in, let's say 10% of the time or 20% of the time, and get your feelings, about the risk of stocks under control? Because I can show you where you're going to be 20 years from now when you retire with this strategy still working.
So let's talk about your strategy. Okay, we're going to hire you for the rest of this interview to advise us and our listeners. Where should we be? What we should be doing?
Well, I'm from a long line of plain vanilla registered investment advisors that have been pretty much doing the same thing for 50 years now. And what people like we do is, we're not glamorous, we're not hedge funds, we don't live in fancy offices, we don't even charge outrageous fees. My average client fee is 80 basis points a year. But what we focus on is plain vanilla asset allocation, the recognition that different asset classes, whether it's cash or bonds or stocks or international stocks or commodities, all move in different cycles. And we're aware that when bad things happen, it's nice to have 5% of your portfolio in cash so you can pay your client's allowance. Knowing that if you keep that allowance going out every month, you can reload their cash bucket when things calm down. And so there's an interesting statistic I saw recently. If you look at the hedge fund index since 2000, it's up about 17%. Not annualized, total return. So that's barely inflation for the last 12 years.
Oh, so that's the period you were looking at. Okay.
Yeah. So let's say you put all your money in the market at the worst possible moment, January 2000, right before we had the 9/11 attacks, the 2002 recession, and then we had a nice rally in 2007, and then we had Greece 1 and Greece 2, and then we had the financial meltdown. And yet, if you had simply gone to Vanguard and put 70% of your portfolio in the Vanguard 500 and 30% in their aggregate bond ETF, you'd be up about 117%. So the dumb buy and hold strategy that everybody loves to make fun of because there's no fees in it was the winning strategy for most people.
Well, so give us your allocation then. What do you recommend right now? Has that changed over the last few years during the crisis?
It depends on our clients. So we have clients that are sort of oriented towards capital accumulation, and they're tilted much more towards stocks and international stocks and commodities. And then by the time someone retires with us, their portfolio will be 30% fixed income, 35%, 40%, whatever number makes them sleep at night. And we tell them that there's a very realistic draw rate. We can take $1 million, draw 4% out a year, every year for the rest of your life, and never run out of money. We can draw 6% out per year. That's on the aggressive side, and you probably won't run out of money. Once you go to 7% or higher, you will probably run out of money. And that's not anything magical. That's simply looking at all the statistics we have for U.S. stock markets and international stock markets for ever since 1945, which is what I regard as the modern era. And I can imagine scenarios where that formula would fail. For example, if there was a nuclear war, our asset allocation strategy would be canned goods, all right? But short of that, stocks, bonds, cash, commodities, international, a nice mix, rebalanced twice a year, and you're good.
A very bearish view right now, theme is the governments are not getting their debts and their budgets under control. This is going to blow up in the world's face at some point. There's going to be defaults, the big kaboom, as Jeffrey Gundlach from Double Line put it recently.
I totally agree with that. If the United States government does not change the policies we have in place right now, we will be as Europe is 15 years from now. They are our future. Now, the good news is, one, we can see it, and two, Americans are not remotely as patient as that. I got to say, I was a little underwhelmed by the budget deal that went through last month because it raises an extra $900 billion over the next 10 years based on higher income rates at the top level. Well, the deficit is about $16 trillion for the next 10 years, so we've only scratched about 10% of the risk there. But at least people are aware of it, and maybe they'll address it aggressively.
We return to our guest in studio today, David Edwards, president of Heron Financial Group. I wanted to ask you about bonds, but since we just heard about Japan, Asia, you say you're looking at the stock market and your strategy from a global point of view. Mm-hmm. How does Asia fit into it?
Well, there's two Asias. There's the Asia of Japan and Australia, and the Asia of everything else. And Japan fascinates me. It's been a zombie economy for 25 years now. And I don't know why the yen hasn't totally collapsed. It seems to have this magical strength. I think there's some dynamics there that the Japanese pull in their currency whenever they feel anxious about things. That's something I can explain. Australia doing very well, but that's based on a commodity economy, so that's tied to China. And then you have this incredible growth economy in China, India, Thailand, probably Myanmar or Burma, as it used to be called, in a couple of years, Vietnam, for example. And so we would normally have a 5% exposure to emerging markets, which includes those parts of the world, plus also Africa and South America and the Middle East. And the reason why we only have 5% exposure there is because it's very volatile. And so those markets did very well in the mid-2000s and went from being 5% of our allocation to being 8 or even 10%, and we systematically sold it back to that core holding, which was a good thing because in the last 5 years those markets have been terrible. The top performing market in the last 5 years is the United States. So it's a little bit of extra juice in your portfolio, but it's not for the lighthearted.
The Nikkei 225 has had a great run over the last couple of months, just since the beginning of December, up about 14%. Are you exposed
A little
specifically
bit
to Japanese
a little
stocks,
bit.
though?
It's when we expose ourselves, when we take exposure to emerging markets, we just do it through plain vanilla ETFs. I don't have the expertise to pick individual stocks in those markets, and I don't think even think it's an advantage.
Okay, how about technology stocks? Since we're getting Google today, Apple tomorrow broadly, is that something you're invested in for your clients?
Yes, we spend a lot of time thinking about technology stocks. Our three biggest sector allocations are technology, healthcare, and financial services. And technology stocks in particular, we analyze using a model that was first developed by Boston Consulting Group. And it's basically the startup to rising star to cash cow to dog model. So when a company is first running off the ground, it has lots of excitement going on. Maybe you're collecting lots of eyeballs, like Facebook, for example, but there isn't a lot of revenue. And if there's no revenue, there's no earnings. And so those are very risky propositions to get involved with. Once the company starts to take off and the revenues really start to flow in, for example, Google about 4 or 5 years ago, that's when we want to invest in it. We didn't buy any internet stocks in 2000. We bought a ton in 2002. The prices were way down, and the revenues and earnings were real. But that very rapid period of growth and positive cash flow doesn't last forever. There's only so big you can grow. At this point, Facebook has 1 billion eyeballs, right? Where are those eyeballs coming from? People don't have the access to it. But what really bothers us about Facebook is that, yes, they have the eyeballs, but they never have the revenues. So, you asked me a few months ago, at what price would I buy Facebook? And I said about $1 a share. And I think it was 18 or 20 at the time, and maybe it's a little bit better now. We certainly have Google, right? And we certainly have Apple. But we have been net sellers of Apple for the last year. And the reason why is that when Apple invented the smartphone market and then created the pad market, the iPad market, that was a time of incredible revenue growth, incredible cash flow. Just people were so excited about it. Well, now we're getting to the point where everybody has an iPhone. Everybody has a tablet. Plus, there's more competition now. The Android is coming there from Samsung and other vendors. And so the time of rapid revenue growth is tailing off. And we're transitioning in Apple from a rising star to a cash cow.
Would you continue to sell just under $500 here and then get back in?
Well, as you go from that transition from rising star to cash cow, the PE compresses. So a rising star deserves a PE of let's say, 25 to 55. But a cash cow deserves a PE of 10 to 20. A classic cash cow company is Microsoft. They pretty much fell off the development curve in 2000. We haven't owned it since.
Okay, David, you're going to have to come back soon.
Sure.
David Edwards, President, Heron Financial Group, with a look at 2013. His message, hey, if you're not in stocks, get in now.